Hey, welcome to Working Cash Flow Pro. That switched over. I wasn't expecting that to switch over here just yet, but we're gonna do some live IUL illustrations today. So thanks for joining us. Be sure to hit that like and subscribe button if you find value in what we're providing today. Over the last week, we put out a two-part series that was a response video. A ton of good information about IULs in that. Be sure to check that out. I said in those that I was going to put out a part 3 for that, and that was where we're going to play around with the illustrations. Well, we're going to do that live here, and then I'll turn that into that part 3. So this is the part 3. You're going to be making it along with me. What I plan to do from here on out is do live streams on Tuesdays and Thursdays, where on Tuesdays I will do IUL illustrations. These will be actual illustrations. You guys will be able to tell me in the comments what you want to see, and I'll illustrate it for you. And we're going to be in real time. So I'll share the PDFs with you. If you want to make changes to it, if you want to see what happens, see what it does, if you tweak it in any particular way, this is your chance to be able to ask to do that. So we'll be able to look at a number of different illustrations and scenarios. We're going to do IULs for that on Tuesdays, and we're going to do whole life on Thursdays. So be sure to hit that like button, subscribe if you want notification when we do those live streams. After the live stream is done, I'm going to be deleting the live stream and taking from it things that I can turn into regular videos. So you guys can see the regular videos later on if you miss the live stream, but you might miss some of the interaction that we're doing during that live stream. And if you want to participate in those policy designs, you'll want to be here for the live stream. Now, we'll also do policy reviews. So if you have a policy that you would like me to review live during one of these, again, IULs will be Tuesdays, whole life on Thursdays. And we do have somebody that sent us in a whole life to review this Thursday. So it should be interesting. Hopefully it'll be educational to you guys. Somewhat entertaining will be our goal. But really, this channel, we're all about educating you guys on these things. And I get a ton of agents that watch this. And so we're spreading the word about how to design really good policies. There's a lot of other YouTube personalities out there that like to point out that that they like to design the best policies, and that they're fiduciaries, and they don't actually design the best policies for cash growth purposes. A fiduciary, if you're aware, is not required to reduce their commission. So we could have two policies, and you're going to see this when we go through our illustrations. You could have two policies, one that pays a $30,000 commission and one that pays a $3,000 commission. Vastly wild cash value available in the early years. There's obviously a significant impact in the later years if you pay a massively bigger commission. And a fiduciary is not required to consider a reduction of commissions as part of their fiduciary responsibility, which is fine. That makes sense. I mean, people have different business models. We talked about this last week. People have different business models. I'm not hating on anybody if their business model requires them to have a higher commission. What bothers me is when we dance around that subject and you guys don't know that you're paying a higher commission for working with that agent and making sure that you get the value from that, as opposed to just getting a policy that has a lot less liquidity and is a lot more risky. Because that's ultimately what it is, right? Now, there could be agents out there that insist on charging a big commission, and they're going to provide you with some type of service that makes it worthwhile to pay that bigger commission. But in my mind, you get to make that choice, okay? If you want to go shop at Walmart or you want to go shop at Macy's, the choice is yours, right? But you kind of know what you're going to get from that. You expect, I would think, to maybe get some better quality stuff at Macy's, right? And you're going to pay extra for that. When it comes to the life insurance, in my mind, there's not a whole lot extra that you're able to get. Because it's not like we're going to do your taxes for you. We're not going to do other investments for you, right? We can talk and we can advise you to go talk to other experts in that field, but your life insurance agent is not an expert in those other fields. Okay. If they're focused on being the best life insurance agent that they can be, which hopefully they are, there's a lot of products to stay up on top of. There's a lot of education to stay up on top of. I don't even have my health license because I'm so focused on high cash value life insurance. I don't have time to mess with anything else. To keep up on the education with it, to keep up with the different product changes, the designs that you would have to do with those ones. Like, that's a lot of stuff to add on your plate when you're doing what I'm doing, which is I work with a lot of people. I design obviously the best policies with the lowest possible commission. Now, I make good money with that, but I also work with a lot of people, so I have less time. You could end up working with somebody that works with a lot less people, pay them a much bigger commission, and maybe they'll do a little better job helping you out with those other aspects. Long-term care insurance. You can even get long-term care that's tied in with a life insurance policy. I can't do that. Some of my team members can. They're licensed for health. But I can't do that. So usually if you want anything that has to do with long-term care, I'm going to refer you to one of my team members. I know that even though they're doing life, they're going to be designing you the best policy possible, just like I would design it if I was life licensed or if I was health licensed. So you still get the advantage there. And of course, they have me as a resource to stay on top of all of the changes that are happening in the life insurance space. It helps when we have other resources in that regard, right? And we do it all for as streamlined of expenses in a policy as we possibly can. We don't dance around that subject. Just know that fiduciaries, getting back to that, fiduciaries are not required to reduce their commission. So you could have a policy that pays out a $30,000 commission, and your fiduciary will have no issues recommending a policy like that, and they do. And there's nothing that the law is restricting them from being able to do that. It's not there. It doesn't happen. Okay. Different business model, but you should be aware of it. So when you're shopping around, you're getting what you pay for. That's my main goal. I don't care how much commission you decide you want to pay out there. Just make sure it matches what you're trying to do. Right. And that you're okay with it. And when we go through all the illustrations, certainly if you've met with me in person or via Zoom, we go over how the commissions pay out. So you know what it takes. And that will come up as we do these designs. Anybody who watches my videos should be able to recognize what type of commission is going out, how that affects their policies. Chris says, you enjoyed the first two parts so far. Good. I'm glad. So we're going to get into designing the third part today. I'm going to copy what he did in his illustration. So I'm going to start doing that now. I don't think I can share this screen with you guys because it's the actual software where I'm going to be illustrating it, but I'm going to turn it into a PDF, and I'll make the changes. We'll turn it into a PDF. It'll happen very quickly so that we can make the changes that we need to make. And hopefully we won't have much dead space here. And also what I'm going to do in the future is I'm going to bring on some of my team members, and they will help me do the designs so that we can get to changes quicker with you guys. And then we can also have a back and forth. Basically, my hope is that we'll get enough viewers here, and you guys will throw us some design illustrations, and we'll be able to just handle it a lot easier with two of us as opposed to just me. And I'll rotate. 1 week, I'll have somebody who does do health, and then maybe we can do some illustrations with long-term care on those weeks. So keep an eye out for that. I will try and have in the title who's going to be with me and what we'll be able to do for those illustrations. So let me do a quick design here of the one that we're matching with that Life 180 video. What was the death benefit? The death benefit was, I believe, $500,000. Increasing for age 64. paying the guideline annual at 16,716. That looks like the right one. And making those payments through age 50, I think it was. I might have to pull up that video and double check. I think it was through age 50. And then we had an income stream beginning at age 51. It might be age 54. Let's see. Oh yeah, it was just 10 payments. It was just 10 payments. Loans beginning at, yeah, that doesn't, oh yeah, let's go to monthly here. And that gets us how much? 76,824. We're very close. We're very close in the design. His design had 77. So what am I off by? 17-year-old juvenile, increasing through age 64, 500,000. Chris, hey, oh, age 55? Let's go to age 55. What does that give us? And that gets us up to 92,000 in projected income. What's the difference here? Let's check the index allocations. Am I at 6%? I'm at 6%, 0.9 bonus. 54 does not work for that. Let's go 2. Nope, that's 81. I always try and match income starting at age 51. Okay, that's what I thought. Thank you. Appreciate you checking on that. So this is coming up with 76,824, which is not quite a match. What else am I missing here? I'm missing something else. And I'm not sure what. We're at 6%. That one was at 6%. We don't have any extra riders. Well, we're going to do a report on this one and we'll just compare it. I'm going to do the PDF. I'll share the PDF. We'll take a look at that, and I'm going to pull up that video. One of the downsides to watching this live stream is not everything's going to happen very quickly like it will when you're just watching my videos. And I cut out all of the dead space. So let's share. Let me share that screen. Let's shift over here. Let's share that window. All right. Is the sound good here? Sound coming in okay? I forgot to check that at the beginning. I'm assuming it is, since you guys haven't said anything about it. So here is our design. I'm just going to go here so we can see the numbers. 16, 7, 16. Oh yeah, I didn't optimize this design at all. This is a high commission design. That's the difference. This is a high commission design. Shayna, thank you. Okay. Glad you guys are all here. So I realized what I didn't do. I didn't optimize this. So take a look at this. This is what that fiduciary person that I was mentioning might design a policy like this for you. Remember, the one on Chris's video was an optimized design. This one is not an optimized design. If you look right here, let's see. So right here. Oh, it's not highlighting it when I do that. All right, well, down here in the bottom right corner. There we go. I wonder if I can do it this way. I'm supposed to have a shortcut here where I can draw There we go. Right here. Oh, the drawing is not showing up on the video. That's interesting. All right, well, no video, no drawing. I'll have to figure out a way that I can make that happen another time. But on the bottom right here, this T stands for target premium. And target premium essentially tells you how much commission the agent's going to make for their first year's commission. Okay. Agents generally make 100% of target premium. Now, Chris in his video said the Allianz pays out more. They pay out up to 155%. That's not what agents make. So he's at like the FMO level where like they would get paid that, but then the agents that contract under them would get a smaller amount. Okay. So there's hierarchies in life insurance, and the agents don't hardly ever realize more than 100% of target premium in these things. Okay. There are some that offer that, but for the most part, the FMO offers you resources. They've got to make some of that money from that 155%, if that's the number. I've never seen that far into the back end of this stuff. So as a general rule, just consider 100% of target premium as the agent commission. Okay. So in this scenario, we have not much cash value in year one. We have a lot of accumulated value, but the difference between these two numbers is the surrender charges. And anytime you have a big commission, in this case, it's about a $6,600 commission, you're going to have big surrender charges, really high surrender charges. Okay. Let's go to the expenses real quick, because this is something that everybody should know. So our policy charges ledger. I want you to look at this. This is our per unit charge. Not a lot of people point this out. This per unit charge, sometimes called the premium fee, this is where they recoup. This is where the insurance company recoups commissions, the cost of underwriting, medical exams, ordering medical records, anything that it took to sell you the policy. So we see the biggest numbers here when we have a high commission design. You can see $22,106 over the course of 16 years. That's what they're recouping. Okay. 6,000 of that, 6,600 approximately, goes out to the agent in commissions. It'll be slightly more than that because the agent also gets paid a little bit on the excess above that. So if you're putting in 16,000, you're putting in an extra $10,000 basically, and that might be like another $250 to the agent. Okay, so it's a little bit higher than this. That's the number to watch. And then we have our cost of insurance. So when this is a high commission design, our cost of insurance is just going to be here in the cost of insurance column. Remember in that Life 180 video, it was split. The cost of insurance was split between the rider charges and the cost of insurance because it was a blended design. There was a supplemental term rider that was used to reduce these numbers right here. Okay, so let's go down. Let's see where our expenses are at. When we get to, here we go, age 97, age 95, we're essentially at 930,000. That's very close to the expenses that was in the optimized design, right? But the difference is, where do those expenses occur? And in this design, you get a lot of expenses up front. The total policy charges, you get a lot of those expenses right here. It impacts the cash growth, okay? And the cost of insurance is actually going to be lower in the other design for a number of years. And then the cost of insurance, when you add the rider and cost of insurance, rider charges, generally you're going to see a little higher cost later on in the policy. Part of that is a reflection of we have more cash growth in the optimized policy. And so we're required to carry more insurance. But part of it is the cost of the insurance in the rider charges section is generally a little more expensive. The cost per thousand is a little more expensive than this one if you just look at the cost of insurance, not accounting for the extra commissions. Okay. It ends up being worthwhile because we reduce the expenses so much in the early years that you get decades of compounding before that cost of insurance surpasses what it would have been had you paid a higher commission. Okay. So that's important to understand. Let me see if I can minimize this. And then see if we can create an optimized design that matches the one from the video. We got 100, 400, 16,421. What we're able to put in. So we're putting in slightly less money. That gets us to 82. That gets us to 82. What am I off on here? Again, I'm off by something. I'm not sure what. All right, well, let's just do this report and we'll see if we can figure out what it is. All right, let's adjust our screen share. Here we go. Here we go. We're sharing this entire screen. Now I can draw on it. Okay, good. We fixed it. So what we did was we went to a more optimized design, 100,000 base, 400,000 of supplemental term rider. We're higher in loans. I'm not sure why. I wonder if I go back to annual on the loans, if that drops it down. Nope, still too much. That gets us to 80,000. Oh well, no big deal. So even when I try, I can't design bad policies. My policies are just good. Our target premium dropped down to 1,300, so our commission's 1,300 in this case. Okay, we're making the same assumptions. We got 6%. Is what we're assuming. Here's our cash value in year one, 12,369. Premium outlay 16,4. So the outlay is a little lower. We had 16,7 as the max that we can get into the other policy. This one's 16,4. But let's see what it did to our expenses. Since that's fresh in our minds, let's go to the policy charges ledger. Here we go, policy charges ledger. Look at this. That's $1,000 less on that per unit charge every year for 16 years. So we have a total of $6,000 instead of $22,000. That's huge. That's all of that is savings that translates into higher cash value. Now our cost of insurance. Let me see if I can bring the other one on here. We can look at them side by side. This is a good way to highlight the differences in policy design. So here we go. We've got a total, let me see, right here. Add those two together. So we got almost $400 or just over $400 total cost of insurance. Over here, $339. $339. Okay. So slightly less expensive, but not in overall cost. You can see our overall cost, $1,000 higher. Total policy charges. Our total policy charges stays lower for a long, long time. You can see here by year 10, we're at 22,000 in total expenses. This one's at 31. By the time we get down here, year 15, 41,000. Now we're at 14,000 less in our optimized design. Okay, let's go all the way to 97. Actually, let's look at 77. We're at 199. 77, we're at 202. At 77, we're still higher in expenses in this scenario. We're going to go back and we're going to look at the cash value difference. The cash value is going to be quite a bit higher in this one. So even though it looks like, oh, by 77, they're almost even. Nope, not the case. Because you have a lot more cash value in the optimized design. By age 82, this one has potentially cost you $2,000 more. Over here, 267 and 269. But we're going to look at the cash value, and the cash value is going to be significantly higher here. So let's go to age 97. That's where the video was at. This one's at 950,000. This one, 933 in expenses. So we end up at 17,000 more in expenses by age 97 in the optimized design, because that cost of insurance and the rider charges is a little bit more expensive. Okay. Where's our cash value? Let's go up. Let's take a look at this ledger. We don't want the guaranteed scenario. We want the non-guaranteed scenario, otherwise known as the current scenario. Remember, the one on the right is our optimized design. The one on the left, our not optimized design. Here we go. Let's line these up. So by year 10, we've got 193,000 in cash value, still 7,000 in surrender charges in the non-optimized design. In the optimized design, 208,000 and only 1,000 in surrender charges. So our actual accumulation value is 209. It's $9,000 higher. The amount of access to cash is $15,000 higher in the optimized design. Okay, what was the next year we looked at in our expenses? Age 77. Here we go, age 77. You can see the age right here. Okay, age 77. We're at 476,000 in cash value, and we've pulled out 82,000 a year in potential income, almost $2.1 million. Okay. Over here, age 77, 458,000, less cash value, and we've pulled out less in income, potentially $150,000 less in income. That's a significant difference. I like to look at these without income so we can see what the actual numbers are, because obviously the income is assuming that there are some arbitrage happening there that may or may not play out, right? But if we don't do the income, then this could potentially be your policy, and you get to decide if you want to just see how that cash, how the cash is potentially impacted by just the optimized design as opposed to a non-optimized design. Here at 51, before we started taking out the different income streams, this one was at 967,000. This one was at 903. So the impact on a higher commission design, potentially $60,000, $64,000 in compounding for you. That's a big difference. And that, remember, we're looking at 6% average growth, plus we have that 0.9 bonus. All right. So this is our optimized design. Let's look at, we're going to get rid of the bad design. We don't need to look at that anymore. We know that this is bad. Okay. Let's see what different income streams would look like if we make different assumptions. If you want to see any particular assumptions, put them in the comments and I'll run those numbers. But what I'm going to do right now is we're going to assume no growth in the index. The current charges remain the same. And I'm not going to illustrate an income stream, because if I do, it's going to assume an income stream. Well, I think I can illustrate a potential income stream in that scenario. If I only go in and look at the guaranteed, it'll try and pull out the same amount of income, even though we know that the performance was 0%. And there's no way you're going to try and pull out the same amount of money if the index did not perform the way that we expected to. So I'm going to plug in 0%. We still have the 0.9 bonus, which is guaranteed. So This is essentially going to go up by 0.9% each year. So zero those out. We may not even get, we may not even be able to get an income stream. If you only fund it for 10 years, that's the problem. This thing may not survive if you only fund it for 10 years. So we're going no income. Let me see what we're looking at here. So this could potentially lapse at age 79 in that scenario. Let's put this up here. Let me save that as a report. Policy year 62. Okay. Policy year 62 is the projected lapse if there's no growth in the index ever and you just hang on to that 0.9% bonus. Okay. No chance for income. All right, here's our numbers. Decent cash value out of the gate. And we have high expectations for this policy. And then we get a 0 year. And then we get another 0 and another 0. And every single year ends up being 0. Now, if we go into this expecting that we're going to get 6%, maybe a little better, maybe a little worse, maybe a lot better, we definitely don't expect to get a 0%. But if we did, are you going to want to keep funding this policy? If you get 7 years of 0% in a row, are you going to want to keep funding this policy? Maybe, maybe not. I guess it depends on what the rest of the market's doing. I mean, if we have 7 0 years in a row, the general stock market is probably garbage. A lot of your other investment options might not be very good either. So that's why I say maybe. But let's assume that that doesn't end up being the case. And there are better options out there that you feel like you would rather go invest in. You're not going to keep throwing money into this policy. Okay. Now, what are the odds of a 0 every year for 7 years with a volatility index? Probably close to 0. I can't say 0 because who knows? It could potentially happen, right? But it's probably close to 0. Your volatility index shifts money. It avoids volatility by shifting from equities to bonds and cash. It's not very often that equities go down and bonds go down. That did happen last year in 2022. So we saw all the volatility indexes did bad last year. But that's not generally the case. In 2008, the S&P 500 lost 40%, and the PIMCO volatility index that Allianz offers went up almost 6% that year. The Bloomberg went up almost 0.5% that year. So pretty good performance in relation to the actual stock market. So just because the overall market might do bad doesn't mean your volatility index is going to get a negative return or you get a 0 credit. So the assumption that there's going to be 7 years in a row of 0, very, very low likelihood in my opinion. Okay. But let's continue to play this out. You get 7 years of 0 and you're like, nope, I'm going to stick with it. We're just going to keep putting money in and I'll just stop after 10 years and we'll call it good. Well, going up at 0.9%, you can see we're still paying for, $500,000 in death benefit all this time. We're getting a little bit of growth, but at some point here, right here, age 45, the cost surpasses the growth. And so we're going to start to see that cash value decline. Okay. You've made it to age 45, didn't put any more money in after the first 10 years, and your account value is just now starting to decline. This is now 28 years of 0%. Assuming you didn't do anything in this and it just kept getting 0 after 0 after 0 after 0. Okay. Not likely to happen, but yeah, it might. All right. Let's say we get to you get to retirement age. You're going to retire at age 65. We're now at 48 years of 0% returns. You still have 129,000 in here. I mean, if the overall market has been that bad that the volatility indexes have been getting 0 for 48 years, this probably wasn't the worst place to keep your money. In all reality, probably not the worst. You would have certainly been better off in whole life in that scenario because you get that guaranteed growth, right? But oftentimes the decision isn't between whole life and IUL necessarily. It's oftentimes between, do we invest in the market or do we go with the IUL? Do you put into a traditional retirement account or do you fund your IUL? Do we split? Do we put everything into a whole life or do we put some into a whole life, some into an IUL? Like those are the kind of conversations that we tend to have. It's not necessarily you putting all your eggs in one basket and that's the IUL. Okay. So in this scenario though, you get to retirement, you got 129,000. You know what? You're probably just going to take it out. There's no taxes because there's no gains in this thing. Okay. You've put in 160,000 over the course of 48 years. You lost 40,000. I mean, all the expenses have been covered as well. But essentially you had a $500,000 death benefit for 48 years at the cost of, well, actually it's more like 35,000. That's not too bad. Actually, that's not too bad. So this is like worst case scenario, right? Not likely to happen. But there are ways that you can manage your policy at any point in here. If this thing keeps getting 0 years, most likely you're going to look to do a 1035 exchange and move this into whole life. Because I'm assuming the market is just garbage. The regular market, the stock market is garbage. So you're not going to want to take your money out of this and put it in the market. Right? Most likely. So you could 1035 exchange it, put it into a whole life policy. As long as you can still qualify for insurance, that's a viable option. You don't have to keep in here for that long. The reason you start in here is for the growth potential. We have really good growth potential. The actual average in these indexes is over 10% with this bonus option and the current participation rates. In your whole life policy, dividends are between 5 and 6%. So you do have better growth opportunity here in the IUL. We just have to understand in worst case scenarios, you're probably going to want to manage that policy and maybe not keep it if that's how it plays out. Realistically, not very likely to happen, but it is possible. Okay. So in this scenario, we've got an IUL, very low cost of insurance in the early years, guaranteed to go up at 0.9% with that particular bonus. If you're in a whole life policy, most of your guarantees are at 3%. So you've got a difference of 2.1% in guaranteed growth. That's not a whole lot of difference in guaranteed growth. Now, the whole life companies we like to use, they pay out profits to whole life policy owners because it's a mutual company. And the dividends are much more consistent. So the dividends should pay out above and beyond that guarantee with those carriers. They've paid out above those guarantees for 150 plus years. There's a good reason to assume that will continue. Okay. There's no beating around that. I like whole life for that reason. Like there's a place in my portfolio for whole life, but there's also a place for the IUL. So what happens if we get a very meager return? We know what a zero return does now, right? But it's not very likely to happen. What happens if we get a 1% return? How does that change things? Let's take a quick look. And remember, if you guys want to see any numbers in particular, put it in the comment and let me know. But I'm going to bump this up to a 1% return. I still think that that is being way too conservative for what we should expect to happen. So let's move this one out of here. Let's bring this one in. I don't want that there. There we go. Okay. How's our assumptions change? We've got a 1% return now. Okay. These don't fit very well on the same screen. There we go. So year 1, slightly more cash value. By year 10, we've got 156 in here. We got an extra $7,000 by year 10. We haven't quite broke even. Do we break even? Yes, we do. Looks like we break even right around year 14. So with a 1% growth, we end up making more than we put into the policy by year 14. Okay, let's go down a little farther. It does continue to keep going up. Does it ever go backwards? Yes. So we peak around age 61, 62. We peak at age, 63. We peak at age 63 at 231,000. In the zero growth, at age 63, we were at 137,000. So we're almost $100,000 higher if we get a 1% better return than zero every single year. Okay, this is a 1% average now. Shayna asks, would you say if I wanted to get policies on nieces and nephews, do you get a family policy or individual policies? For you to get policies on nieces and nephews, that would be individual policies. You might be able to do that. It depends. The challenge generally with getting policies on nieces and nephews is what is your insurable interest in them? And the dollar amount is usually not very much. So like they can't qualify for half of your death benefit. Might be able to get them the minimum amount with Allianz, that would be 100,000. Okay, but they're going to want to see life insurance coverage on their parents, the nieces and nephews. And then they're going to want to know, how come you're owning this policy and not the parents owning the policy? So those are things that we can have a discussion about and figure out the best approach if your interest is in getting it on nieces and nephews. So like, what's your overall goal? If the goal is to get something for them, then you can always have their parents buy the policy and you just promise to fund it. And you just gift them that money every single year. You can do $17,000 in gifts every year without having to file a gift tax exemption return. Okay, so that's often the best way to do that. But we would want to have a conversation about that to figure out what's the best way to go about it to align with your goals. If you want to maintain control of the cash value, it becomes a little bit harder. Not impossible though. So just sign up for a meeting with me. We can discuss it. So 1% better return by the time we get to age 77. We're at 169,000. In this one, age 77, it was almost about to lapse, 33,000. It lapsed a couple of years later. This one projects to last until age 84, and then it runs out of money. Now, if this was getting 1% every single year, are you going to wait for it to run out of money? I guess it depends on how much you think you might need that insurance when you get into older age. Odds are you're going to do something sooner. At some point back here, when you have a lot more money, when you get to retirement at 65, you got $230,000. That's more than you paid into it. And you might be able to go put that to better use. You might need that as an income stream as opposed to paying for a death benefit for the next 20 years. So those are the reality on the ground. What would likely happen as opposed to you just letting this policy lapse eventually at age 84? And what was the value out of it? You got $500,000 death benefit for 67 years. Okay, that's valuable in some sense, but I think it's more valuable most likely if you got that $500,000 death benefit for 48 years and then you pull out $230,000. And then you got something to pass on potentially, or something to use while you're still alive, as opposed to just giving it to the insurance company when the cost of insurance is a lot higher. So when people complain about these IULs and they point to the guaranteed scenario that's not likely to happen, and they try and instill fear that this policy could just lapse at any moment, that's not a reflection of reality and what would likely happen. Let's go to the expenses here. Okay. We know at retirement age, there's $230,000 in here. What are our expenses? Here's our policy charges ledger. At age 65, here's retirement. $5,000 for that year is our expenses. Is it going to lapse suddenly? No. How many years can we go with just those expenses? Like you can go a lot of years before that eats up $200,000 in expenses. And you don't have to. You don't have to let it go that far. You could take your money out at any time. You'll pay a tax on the little bit of gains that are in there. but at least there was gains. At least there was gains. So you could always keep it until the cash value drops below those gains and you won't have to worry about taxes. I don't think that's a preferable option. Okay. But our cost of insurance doesn't get expensive, real expensive. You can see until like mid 60s where it gets to be a few $1,000s. And then it goes up from there. What happens? I'm going to close this one. What happens? I'm not going to do 1% jumps each time. What happens if we get a 4% return? Or 3? Let's do 4. We're going to do 4% return. If we get a 4% return, we still have that 0.9 bonus. So this is now a 4.9% assumption being made. Are you guys finding any value in this? Getting any more insight than maybe you didn't already know? If you are, tell me in the comments. You guys are awful quiet. All right, here's our values at a 4% return. Break even happens in year 9. Maybe a little sooner. Maybe year 8. I can't see the total charges. Actually, almost happens here in year 5. You can see we have 79 available, 82,000 that we've paid into it. So it's possible that we get a break even somewhere in 6, 7, or 8 at that 4% return. Oh, good. Thank you, guys. Thank you for the feedback. Now, 4% return. We get to retirement age 65. We got $1 million in there. Average of 4%. Back to the 0. When it was a 0, we were at 129,000. So we've got a huge difference. Our expenses are low still in this scenario, and we should never run out of money. And in fact, because I stopped illustrating a loan, right? I stopped illustrating income. We don't ever run out of money in this scenario. And you can choose to just take your money and walk away at age 75, $1.5 million. You borrow, you don't have to withdraw it and pay income taxes. You could borrow it out, trigger the overloan protection rider. You get 95 to 99% of that value. Different carriers have different numbers. I don't recall what Allianz's is to trigger that overloan protection rider. But I've seen 95, actually some are at 94. So I'd say 94 to 99% of that. I've seen, or 98, I should say 98. I recall one carrier has 98% as what you can get for triggering that overloan protection rider, and one was at 94. That's pretty good. You don't even have to get into the high expense period. Let's see what our policy expenses look like. Policy charges ledger. Here we go. Policy charges, nice and low. Now the policy charges end up nice and low here because we've made quite a bit more money. We've made quite a bit more money. They'll be higher in this range because we made more money and we're required to carry a little more death benefit down here. But you can see the costs are not super high. By the time we get to age 77, so $3,000 costs. So these numbers are less expensive than in this scenario. Let's go back to the policy charges ledger here. There's a reason those numbers are less expensive, okay? I'm going to go over that with you. So age 77, the expenses in this one, $16,000. That's because we still have a lot of death benefit in here. Okay, I can force it to go lower, but I didn't. I didn't force it to go lower. And in this scenario, it automatically goes lower because that cash value is higher. And it was a lot closer to the death benefit amount when we were able to illustrate the reduction. And for some reason, the software, it just doesn't allow it to reduce as much. Let's take a look here. At 77, you can see the death benefit. We're essentially paying for less than 100,000 in death benefit in this scenario. Over here, this is illustrating age 77. This is illustrating paying for 470,000 in death benefit because it didn't let it reduce lower than the original 500,000. That's the software limitation. You actually can reduce that death benefit. We can reduce that death benefit. Watch what happens. We're going to go back to the 0% return, because if you actually got a 0% return, you may not want to keep that much death benefit. So when will you do the reduction in death benefit? We're going to do that reduction as soon as possible. I'm going to illustrate it starting in year 11. So we're going to make that reduction in year 11 as soon as you stop funding it. That's the soonest we can reduce the MEC limit. So let's make this 10. Make this 11. Let me see if it forces that down. Nope, I'm going to force it to go down. Let's go year 10. See what it'll let me do for forcing it down. We're going to drop it down to 125,000 total if it will let me. Sometimes these software limitations are too great and it won't allow me to do that much. It won't let me reduce it that much. Let me reduce it to 200,000. Still doesn't want to let me do that. It forces me to take money out. That's what it's doing. Let's see if we go. Need it to be lower though. Okay, that worked at 300,000. All right, let's take a look at this one. Let me print this report. Let's get this one out of here. And let's bring this one in. This is now a 0%, but we managed the policy. So you went 10 years hoping to see some growth and it never materialized. This is a 0% every single year in this policy. Okay. Let's go same page on this one. Here we go. You can see 148,036, 148,036, same amount on both of these. Okay. And okay, let me see if I can make these a little bit tighter. I don't like not being able to click on these. All right, that's better. Okay, so we've got 148,000. And then in this one, instead of keeping the death benefit at 500,000, we were able to reduce it. It looks like to about 225,000 total death benefit. Our expenses go down. Look at our total policy charges, 716 as opposed to 1,017. They continue to go down because now our cash value can go up quicker. Where does our cash value top out at in this one? In this scenario, boy, we've made it right here. Age 64. Nope. 62. 62. We top out at 174,000. What was this one? This one topped out at age 44. This one topped out at age 44 at 154,000. So just by reducing the death benefit, we were able to extend the money that you put in there, even though there's no return in the index ever. We're able to extend that cash value so it peaks at age 62 instead of 48. Where does this one end up lapsing? Age 85. This one over here lapsed at age 79. Okay. So we still end up getting a lapse, not a whole lot of years later, 6 more years. But at retirement age, in this scenario, we had 173,000, and this one had 129,000. That's a big difference when you're getting into retirement. So you want to make sure that you're managing your policy to reflect what's actually happening, right? We're not going to continue to get 0 year after 0 year after 0 year and just let the policy lapse on a whim. Let's see. Chris asks, what do I think is a safe income to take if it is only around a 5% return? Probably a 5% income. That should be safe for sure. You will probably never run out of money. It will probably continue to grow if you take out a 5%, right? I mean, you're still going to get some years that are higher and some years that are lower. And on those years that are higher, those are going to be some pretty nice returns. So I would think if you take out 5%, you probably won't ever run out of money. Depends on how much money you had in there, obviously. We definitely, if we had a decent return, like in the 4% scenario, and you start pulling out 5%, you'll be able to cover that cost of insurance and still continue to pull that out. And always remember, no matter how this is playing out, once you get past 75, you can always take your cash and walk away. I don't think we're likely to do that because of the potential inside these at such a very low cost at that time. But if we do a projection, and we're going to be doing in-force illustrations for you, if we do a projection that shows that your expenses are getting to an uncomfortable amount compared to what the returns have been and what we think the returns are going to continue to be, you might opt to pull the trigger on that overloan protection rider. Joe C. asks, can we reduce death benefit during the surrender period, say year 5? Yes, if it depends on how much you funded the policy at. If you've been max funding it, then no, because it'll reduce your MEC limit. Anytime you reduce the death benefit, it will reduce the MEC limit. And if you've been funding it to that limit, you're going to cause a MEC. A MEC is a modified endowment contract, and you get different tax consequences, not good ones. We want to avoid a MEC. So yes, you can if you have not been max funding it. Another thing to consider with some carriers, if you reduce the death benefit during the surrender period, they will charge you some surrender charges. Because remember, they're trying to recoup all of those expenses that they did to get the policy paid out. And if you did a high commission design, they need all of those years to recoup that big commission that paid out. And if you reduce your death benefit before then, they're going to charge you for that because it inhibits their ability to recoup all of that commission. And you could potentially close the policy. Dale, good question. Can you do an RPU? No, you cannot do an RPU in an IUL. RPU is a reduced paid up that's available in a whole life policy where you take the cash value and it reduces the death benefit to an amount that's considered paid up. RPU, reduced paid up. That's only possible in a whole life where you have paid up policies. An IUL is never paid up because the underlying insurance is annual renewable term. So the best thing you can do is to withdraw your money or trigger the overloan protection rider after age 75. Okay, trigger the overloan protection rider. The insurance company guarantees they will maintain a small death benefit, a minimal death benefit until you pass away. So your policy does not lapse. Now, the assumption is there will be no tax consequences for that. But they can't guarantee that because, the government could change the rules at some point down the road. But in general, it's to avoid the tax consequences of that. You don't end up with a lapsed policy. You just have a loan. They'll maintain the policy until you pass away. And there's good reason to believe that will be the case. There will be no tax consequences. There's other things involved in that beyond just the government deciding they want more tax revenue. So yes, you can reduce the death benefit, but you might pay surrender charges. Okay. If you do a blended design, if you have an optimized reduced commission design, and we've blended in that supplemental term rider, generally you can reduce that supplemental term without incurring the surrender charges. So there's added advantage to going with an optimized design like we do, as opposed to paying the higher commission designs. Not just the cash value in year one. Miss says, when you do the IUL, do you put a stop on the amount of years a person will be paying? No, you actually have the flexibility to pay or not pay up until age 99 if you want to. Totally up to you. You can choose to stop at any point. As long as there's cash value in the policy, that when the insurance company reaches in every month to pull out the expenses, as long as there's enough cash value in there, your policy survives. If there's no cash value, your policy lapses. So you just need to make sure there's enough cash value in there to cover the expenses. And in the early years, the expenses are very low. So we don't really worry too much about that. So it is possible for you to fund it 1 year, and that policy could potentially survive for life, depending on how the index grows, right? A lot more likelihood if you fund that policy at 5 years and then stop. Now your MEC stays the same for the first 7 years. So usually when people are thinking of short pays, I usually recommend you might as well just make 7 payments. Plan on paying it for 7 years because you've got that space available. But if you have a lump sum that you're planning on moving in over 5 years, know that you'll still have that MEC space available in years 6 and 7. Maybe you'll end up using it. And then after year 7, we can make a reduction because the first 7 years is our MEC test. After year 7, we can start to make death benefit changes and not worry about violating the MEC limits. So you can max fund it for 7 years and then drop that death benefit down low as you want to. And essentially we can reduce it so much that there is no more MEC space. So if you're not planning on contributing more to the policy, you might do that in order to optimize for cash growth. If you think you might want to continue funding that policy, don't make a change or make a small change, right? You can reduce that MEC limit some. You don't have to reduce it all the way to 0. But in general, and especially with kids policies, if you watch my kid policy video, that MEC space will carry over and add up year after year after year, as long as you don't make any changes to the policy. So you can always decide later on to catch up on space that you didn't use. Joe C says, when you run any illustration with flat 5 or 7%, always it looks good. How about running illustrations with 0 in some years? So you can do a 0 in some years. The thing is like, we can't go above whatever the maximum illustrated rate is. So the maximum illustrated rate right now is 7%. So if I put some 0 years in there, you're never going to see a year that goes above 7%, which is likely to happen. We're going to get some years above 7%, just like it's realistic if I run some 0%, right? What we can do is we can run. Actually, I don't think I can put this in a PDF. I wonder if I can. I can actually look at the numbers that are based on, wait, what do I need to change? I got to change something on here. There's a way I can do that. I can look at a quick view. Why is it not letting me with this one? Oh, it's because I'm assuming 0%. So let me plug in 6% again. And then I can do, nope, that's still not letting me do it. Why is that not letting me do it? I don't want to run a midpoint. It used to give me the ability, maybe they changed it. It used to give me the ability to run like actual returns over the years. So you could see 0 and then it'll cap at the max limit, but it'll vary each year. I'm not sure why it's not letting me do that. I'm gonna have to play around with that. I don't know what the deal is. Something changed. I don't even know if I can share that with you anyways, because I would have to show you the actual illustration software to be able to see that. Now I do share that when we're doing a one-on-one meeting. I share my screen and you can see me design these things. We're not just looking at the PDFs. But if I'm putting something out on YouTube, the insurance company might have a problem with me putting out that proprietary information to the public. You're welcome, Miss M. Avatar says, based on history with good IULs, you've never seen as low as 5%. Yeah, I mean, we've had a good run in the market, though, for the last 15 years, right? Certainly the last 13 minus the most recent year. The market's been pretty good. So based on the history, pretty recent history with IULs, the market has been pretty favorable. It's possible we don't get that same type of a long-term bull run, right? So I'm okay with it being a little more conservative projection based on that. But yeah, I think there's a really good chance. I know there's some people out there that will run Monte Carlo simulations on these things. And if you run a Monte Carlo simulation, I think the last time they came up with it, it was like 100% chance that you would get a 5% or better average in the IUL. There was like a fairly high chance you could still get 7% and 8% running the Monte Carlo simulations. And I don't know which carrier that was with. But it was interesting to see those numbers come out. Josie, 2022 return 0. See also 2018. Yeah, there's definitely been some years that have been 0. So let's take a quick look at that in here. This tells us what the actual return was over the last 17 years with these index options. So right here, this is your Bloomberg. This is the actual return since 2005. This column is the hypothetical return based on the participation rate that the insurance company is offering today. And then you add your 0.9 bonus to that. Let me slide this over. Oh, wait a second. Let me just make this wider because we're cutting off a little bit of this. We can't see the total return. So here's the total return over the last 10 years and over the last 15. You add the 0.9 bonus to that to get the actual return. So that gets us up close to 10% over the last 10 years and slightly less than that over the last 15 years with the Bloomberg. Now, last year was atrocious. It was the worst year for the Bloomberg. It's because our volatility indexes shift from equities to bonds and cash. And what happened over the last year? Everything got hit hard. We had inflation impacting cash. We had bonds dropping. The actual return of bonds got hit massively. It was like the biggest drop in bonds ever, I think. And then we had equities take a massive hit. So there was no hiding from it. That was an anomaly year for sure. But if you were in an insurance product, you didn't experience any of that. If you were in the market, the actual S&P, at one point it was down 30%. So you'd have been happy to get 0. I was happy that I got 0. I mean, I would rather get more, but I was glad I didn't lose money because I was losing money in my stock market portfolio last year. So that's the actual return. And then we go here. Here's the PIMCO. You can see PIMCO does a little better in a rising interest rate environment. So it didn't take as big of a hit. This one's a really solid index. And here's our last 18 years. Overall, slightly lower return over the last 10 than the Bloomberg and very close on the 15-year return. Add the 0.9 to get the actual average. Avatar says you should say not lower than 4.75 in the last 20 years. Yes, last year was 4.75. Never seen 0. You've seen a ton of them. Yeah. Yeah, these are great products. Like, I like these products. No, PIMCO didn't do the worst. This is the volatility index. It's possible that the actual PIMCO index that's not the volatility did worse. But the PIMCO volatility index, which is what we have access to here through Allianz, is an excellent product. And it has a mechanism inside of it that does better in a rising interest rate environment, which is why we only see the minus 2% here, as opposed to a minus 12 in 2022 with the Bloomberg. And we're actually doing better so far this year as well in the PIMCO than in the Bloomberg. So you gotta make sure you're looking at the actual index that we have available. There is a PIMCO index, which Allianz used to use before they had the volatility index. It definitely performs different than the volatility index does. So you got to be aware of that and the differences. I'm a big fan of the volatility indexes. You just don't see the big swings up or down. And we get a really nice high participation rate. That's key. So like most of your volatility indexes, their goal is to return 5%. If this returns 5% because of the participation rate, and then you add the bonus, you're up near over 9% for a return. And you can see there's a lot of years, 5.17, 5.86, 6, 7, 5.7, 4.07, almost 9. And then you've got some breakout years, 10%, 14%, 11%. Those are massive return years. And with the other bonus options that these have available, these can be incredible returns those years. The 40% bonus that I like to use, I pay a little bit for that. But in 2017, your actual credit would be over 30% with that particular bonus option. Huge. And the average over the last 15 years is like close to 13% after you pay that 1% expense fee. So really, really good average with that 40% bonus option. But it doesn't illustrate well, so we don't generally show it. You can't illustrate the bonus performing, but it will put in that 1% expense charge. So realistically, you may not keep it at that bonus the whole time you own the policy. Obviously, you're going to make sure that it's worthwhile and that it's paying for itself. If it's not, we're going to switch bonus options, right? So I think that's about it. Do you guys want to see any other particular numbers with this design? Otherwise, I think we've done a good job here today, illustrating some different scenarios, how you might react to them if it were to play out as poorly as Life 180 would like you to think it's going to play out. Your policy doesn't have to lapse. It may or may not be the best place for you to put money if it's performing the absolute worst that it possibly could. But that's a scenario that's not very likely. So hopefully this was helpful in that regard. I appreciate you guys joining me for this live stream. We're going to be back again next Tuesday, and we'll do IULs again. Doesn't have to be Allianz. This is Allianz here. I want you guys to tell me what you want to see. So I've got access to a whole bunch of carriers we can do illustrations on, see how they look, go through the different pros and cons of them. If you have a policy or even an illustration you would like me to review live on here, email it to me, james@OregonCashFlowPro.com, and tell me that you're okay with me sharing it. And I'll go over it. I'll criticize it as appropriate. I can even do, if it's not an optimized design, maybe I can do an optimized design and we'll put them up side by side and see the difference. So, Avatar asked, do you think the fees are okay with Allianz? Not too high. Yes, I do. There's a reason for that. If you look at strictly the fees between carriers, Allianz seems higher. Their cost of insurance is definitely showing higher, but their load fees are right in the middle, right where they need to be. Okay. There are some carriers that are lower load fees and lower cost of insurance, but what do you get for that? You don't get all the guarantees. You don't get the guaranteed loan rates. You don't get the guaranteed crediting. You don't get the bonus options that are also guaranteed. You don't get necessarily the uncapped indexes. You don't get or you might have load fees that can adjust. They reserve the right to change those. You might have an asset fee that they can add to it, or maybe they already do add to it. Maybe they can add a spread. There's all kinds of things that can change in these things. And so you got to think about what you're getting for those fees. With Allianz, what I see from their business model, I really like it. I think they charge you what they need to charge you for the insurance. And so they know exactly what they're going to have for a budget, for their options budget. And so they don't reserve the right to make hardly any changes in the policy. In fact, when we're using the Bloomberg and PIMCO volatility indexes, the only thing in that policy that can adjust is the participation rate. I mean, the cost of insurance, of course, but that can happen in any policy. But the participation rate is the only thing that can change. With some other carriers, they can change the load fees, the bonus option, whether you get a wash loan or not, how much you get credited, how much you pay. They can change the loan rate on a participating index loan. They can change the load fees. They can change the asset fees. All of that can change. They can change the caps and the uncapped index options. They can add a spread. Like, there's so many different things that can change. Allianz does not reserve the right to do that. And that's because, in my mind, they're charging you what they need to charge you. And so they know what they have available. They know what they need to be able to adjust. And that's the participation rates. And you should check out my video on participation rates to understand those better. What carriers do I mainly use? In the IUL space, I would say 99% of the IULs I do are Allianz. Not every scenario, Allianz ends up being the best fit. And if somebody just wants a different carrier, I'm happy to oblige. It just happens to be that Allianz allows for the best designs that I'm able to do. They have awesome index options, good guarantees. And we're going to hold these policies for decades, many, many decades. Having those guarantees is nice to have with the growth potential that's available in this product, right? So in the IUL space, 99% Allianz, the other 1% spread out among F&G, North American, National Life Group, and Securian. Those are probably all of the ones that I do. No, Nationwide, I'm not a fan of Nationwide. They're the worst when it comes to reserving the ability to make changes to your policy. And we can go over that in another time. We can do I don't know if I can do a Nationwide illustration anymore. I've been contracted with them for a while. I don't know if they pulled that because I haven't sold their policy. We can take a look at it though. And in the whole life space, I probably do 99% Guardian. The other 1% is going to be Mass Mutual and Penn Mutual. And in the whole life space, it's because of the flexibility that Guardian offers. It's not because it's the absolute best product and you can get the most cash growth out of it. I would put Penn probably in that position. But Mass Mutual and Penn don't offer the same type of flexibility. We can't get the same kind of approvals as we can with Guardian. Financial approvals, the ability for you to be able to just stuff a ton of money into these policies. Guardian ends up being the most flexible, very flexible, like an IUL. So yeah, those are the ones I use the most. Joe, can I show AIG policies next time? I'm not sure if I'm contracted with AIG. I'll have to take a look. But if any of you guys are agents out here and you have an AIG, you can send me an illustration. I would love to do that. And I can demonstrate that. I might be contracted with them. I can't remember. I haven't sold their policies. And I think I was contracted with them at one point. But if I never sell their policies, they restrict my access to be able to design, to get into their illustration software. So that's the only thing we'll run into during these live streams is what I have access to. But I'll take a look and see. So next Tuesday, be sure to join us and ask me at that time. You can remind me. And if somebody sends me one. So my email address again, Miss M, is james@OregonCashflowPro.com. And you can replay this live stream if you need to hear that again. Chris says, is the Guardian policy with the indexing option essentially an IUL? What's the difference? No, I mean, sort of. I have a good video on that. Although I think it's a little bit outdated. right now, I think the cap for the indexing option with Guardian is at 11%, and you get a floor of 4%. Now, the floor was at 4% back when the guarantees were 4%. And now the guarantees are at 3%. That floor could end up changing, but as of now, it's still 4%. But it does cost you 2% if you want to participate in the index. So essentially, your net is going to be somewhere between 2% and 9%. That's where the rub comes in. And I generally don't use the index option with Guardian. If our dividend rate is 5.75%, which is where it's at currently, what's the potential upside to use the IUL? Well, we could potentially get 9, right? So we got a 4% upside, but we also got a 2% floor. And it's only the S&P option, the S&P index that's an option. How often does the S&P get over 11 or under 0, right? Or under 2%? You could get or under 4%. It's under 4% a lot. So I'm not sure if the average is worth it. Now, you could try and time the market, move it into the index option sometimes, but it's really hard to time the market. So essentially, if we're in a whole life policy, we're probably not going to use the IUL. So I don't view it quite the same because we don't have access to an uncapped index option. That kind of makes a big difference. And that 2% cost. If it was an 11% cap and no cost and a 4% floor, that would be amazing. I would probably do that every year in that whole life product. But it's not. That 2% cost does make a big difference. What do I think of Transamerica? Let's talk about that next week. I'm not a big fan of the Transamerica products. I have a video out on their new IUL product, which some things got better, some things got worse. Their old IUL product, really, really low expenses, but you only have the S&P index option. There's no bonuses. So there's no uncapped options, and they have an asset fee. They're going to charge you extra. So while it looks like the fees are low in the early years, those fees can get expensive in the later years. So Joe says, shouldn't we keep investment and insurance separate? Investing periodically, low-cost ETF is the way to go, he thinks. I don't think so. For the most part, I would say probably yes. We generally don't view insurance policies as investments. But if you're investing in the stock market, is all of your investment at risk? Do you do a 60-40 portfolio? Do you do 100% in ETFs? Like, what do you do? Everything is at risk in the market. You don't necessarily want everything at risk in the market. And so even people who are 100% in the market are going to hedge. They're going to own some bonds. They're going to own some mutual funds that are very safe, or ETFs that are very safe. I like to view cash value life insurance as an alternative to those safe options that you would otherwise have invested in the market. I think there's a place in a portfolio that it'll help to meet the death benefit need, having that insurance death benefit that's tax-free, as well as the potential safe growth environment. So that's the way I view life insurance. I don't think that you should not invest anything in the market and put it all in life insurance. Not by any means. Like, you have potentially unlimited gains in the stock market. You also have potentially unlimited losses, or limited to whatever your cash value is, right? So how much do we protect from that? Some of it, I like whole life as our savings vehicle, where I store our emergency fund. You don't need to store your emergency fund in the stock market where it's at risk. And if the whole world goes to crap and you lose your job and the market's crashing, are you going to have access to your emergency fund? Maybe, maybe not. Like, that could be a too much risk in that scenario. So you've got to think about the overall picture. And for the most part, I think there's a place in a portfolio that can help the portfolio perform better if we have some money in our cash value life insurance. You say if the stocks are down, insurance indices are down too. Not necessarily, as I talked about earlier with the volatility index options. 2008, S&P was down 40%. The PIMCO volatility index was up 6% that year, or nearly 6%. So not true that just because stocks are down, insurance indices are down. But even if the insurance indices is down, you don't lose anything. So let's say you're getting into retirement. If this is your first year of retirement and you have everything invested in the stock market and it crashes, you're going to have to recalculate what you thought you were able to retire on. If, however, you have some of it in your insurance policies and you can access the cash value you need to live on in a policy that didn't go negative when the market crashed, you could give time for those stocks and things to recover. You don't have to sell at a discount because you have to continue to pay for your living expenses. So I definitely think that there's a place in a portfolio for that. Happy to have that discussion further. Chris, what are the reserve requirements for an insurance company? For banks, it was 10% until 2020. Insurance reserve requirements are 100%. They're required to have a 1-to-1 reserve. Avatar says stocks and mutual funds will keep plummeting for a long time, you think? Yeah, maybe. I mean, most things go up and down. You know, overall, it could have a trend that's down, even though there's ups and downs that happen inside of it. So you're welcome. And I've got to end it here. We're done for the day. I will be back next week, though. Be sure to join us. Happy to go over some more questions then. And on Thursday, remember, we're going to do whole life illustrations and whole life policy reviews. So if you have a policy to review, whether it's an IUL or a whole life, if you'd like me to review it live, we're going to do IULs on Tuesdays, whole life on Thursdays. And our goal is to shoot for 11 o'clock. I was late today because technical problems with the setup here. I'm trying to make this a little bit better visuals. So appreciate you guys joining me. Let's switch back over here. I appreciate you guys joining me today. It's been a good conversation. I hope to see you again soon. Be sure to hit that like button. As always, leave me comments if you have questions. I still answer every comment that I see in the comment section. So the live stream, we won't be able to answer them there, but you can go into the comment section outside of this. Although I prefer you go into a comment section on one of my other videos, leave a comment there, because I'm going to be deleting this live stream once I get it downloaded, because I'm going to cut it up into parts that we're going to turn into actual regular videos that people can watch. YouTube ends up liking those better. Miss M, you currently have a policy with Transamerica. Send me a copy of it. Okay. See if it was done correctly. Awesome. I love it. Love it. What kind of U.S. Treasury bonds do insurance companies buy? Short-term or long-term? Do they allocate the premiums? We pay to bonds right away. Can you remember that question and ask me on our next live stream, Chris? Or in one of my other videos, but I prefer it on the live stream because that is something that I can get into a little bit, and I would love to cut that up and put it into its own video. Great question. Great question. In short, all of it. Insurance companies buy short and long term. So, all right. Thanks a lot, everybody. Take care, and we'll see you later.